What are the tax differences for S Corp versus C Corp shareholders? Imagine running a business and wondering how your taxes will be affected depending on whether you choose an S corporation or a C corporation. It's a big decision that can impact your bottom line. Let's break down what really happens with taxes for shareholders in each type of company. First, when it comes to how income is taxed, a C corporation is treated as a separate legal entity. It pays taxes on its profits at the federal level starting at 15% and often at the state level too. When the company distributes profits to shareholders as dividends, those dividends are taxed again on the shareholders' personal tax returns. This is called double taxation because the same money gets taxed twice. In contrast, an S corporation is a pass-through entity. It does not pay federal corporate income tax. Instead, the profits and losses pass directly to the shareholders, who report them on their personal tax returns. They pay taxes at their individual income tax rates. Many states follow this same approach and do not tax S corporations at the corporate level. Shareholders in an S corporation receive a Schedule K-1 from that shows their share of the business's income or loss. They include this on their personal tax returns. Shareholders in a C corporation, however, report dividends separately, which are taxed as income. Payroll taxes are another important factor. Both S and C corporations must withhold income taxes and payroll taxes for employees. But if an S corporation shareholder works as an employee, they need to get a reasonable salary that's subject to payroll taxes like Social Security and Medicare. Any extra distributions beyond that salary are not taxed for payroll purposes, which can lower overall employment taxes. The IRS keeps a close eye on this to prevent shareholders from avoiding payroll taxes by taking only distributions. C corporations handle salaries differently. Salaries are deductible expenses for the company, reducing taxable income. Dividends paid to shareholders are not deductible, which adds to the double taxation issue. There are also some tax benefits to consider. S corporation shareholders might qualify for the qualified business income deduction, which allows up to 20% off their pass-through income, lowering their overall tax rate. But S corporations are limited to 100 shareholders who must be U.S. citizens or residents. They can only issue one class of stock, which limits their ability to attract diverse investors. C corporations do not have these restrictions. They can have unlimited shareholders, issue multiple classes of stock, and are better suited for businesses planning to go public or seek venture capital funding. Losses and deductions are another aspect. S corporation shareholders can use their share of business losses to offset other personal income, which can be helpful if the business is just starting or not yet profitable. C corporation losses stay at the corporate level and cannot be used directly on personal tax returns. In the end, choosing between an S corporation and a C corporation depends on your business goals and how you want to handle taxes. Small businesses often prefer S corporations to avoid double taxation and simplify tax reporting. Larger companies or those seeking outside investment might lean toward C corporations despite the double taxation because of their flexibility and ability to raise capital. This decision influences not just taxes but also how your business is run, how shareholders are involved, and what legal obligations you face. Consulting with a legal or tax professional can help you pick the right structure for your specific needs.